Retail investors are capitulating. They are panic selling. But look at the data on your screen. While the average holder is dumping their bags, smart money whales just net bought over $2,200,000 worth of render in a single month. We are seeing a massive divergence. Retail is leaving, but institutions are entering. All of this is happening while the price action compresses into a textbook technical structure that is days away from a decision. Most people are going to get chopped up here. They are going to sell the bottom or buy the fake out. Today, I'm going to show you exactly where I'm dollar cost averaging, the specific price level that invalidates my entire thesis, and why the triple-digit yields on Solana might actually be a trap. I'm not here to hype you up. I'm here to show you the data. Let's get to work. So, being honest about where we are. Right now, Render is trading between $1.30 and $1.40. If you have been holding this token since the highs of late 2024, or even from the $4 mark, this has been painful. We are currently in the apathy phase of the market cycle. This is the zone where the volatility dies. The hype is gone, the YouTubers stop posting about it, and this is exactly where the transfer of wealth happens. But here's the interesting part. Despite this boring, grinding price action, Render was actually the top single-name performer in the Coinbase 50 index for January, up over 20%. Think about that. Even in a downtrend, it's showing relative strength against the rest of the market. It's outperforming the DeFi sector and the smart contract sector. The price is compressing. It's like holding a beach ball underwater. You can only hold it down for so long before the physics take over and it shoots to the surface. But the question is, do we have the fundamental pressure to launch it, or is the air leaking out of the ball? To answer that, we have to look at who is actually holding the ball. Let's look at the market plumbing. On January 29th, we got the confirmation that Render is now available to trade on Robinhood Crypto, specifically including New York State. Now, you might think, who cares? It's just an exchange. You are wrong. New York is the hardest regulatory environment in the world for crypto assets. The BIT license is a fortress. Getting listed there is a stamp of approval that essentially de-risks the asset for institutional capital. It signals high compliance standards. This is not just about retail access, it's about regulatory safety. Speaking of institutions, let's look at the Grayscale Decentralized AI Fund. As of February 4th, Render is their third largest holding. It makes up 14% of the entire fund. They are weighting this heavier than Filecoin and heavier than the graph. Grayscale is not rotating out of this position. They are betting that Render is a core pillar of the AI infrastructure thesis. When funds like this hold, they create a soft floor. They don't panic sell because of a 10% drop on a Tuesday. They are holding for the multi-year cycle. However, there's a trap you need to be aware of. Look at the yields on Solana. Right now, Radium is offering concentrated liquidity pools for Render Solana, paying out 140% APY. Orca is offering over 50%. When you see yields this high, it tells you two things. One, there is massive demand for liquidity. But two, it attracts mercenary capital. These are traders who buy the token just to farm the yield, and then they dump the rewards on the market every single day. This creates constant sell pressure. But here is the Crypto Yield Pro take. High yields also deepen the order books. This liquidity allows whales to enter the market without slippage, and that's exactly what they are doing. I want to be balanced here. I'm not a moon boy. There is a bearish signal we cannot ignore. Active addresses on the network are flat. We are sitting at around 2,500 monthly active users. We are not seeing a spike in artists or developers actually using the network for rendering jobs yet. This rally is driven by the narrative of a GPU shortage, not by the revenue of the protocol. That's a risk factor. If the narrative cools, we don't have the user base to support the price yet.
Now, let's put the news aside and let the chart speak. I'm looking at the weekly time frame because the daily noise is irrelevant right now. We are trading inside a very clean, very tight falling wedge structure. We have been respecting these trend lines since the fourth quarter of 2024. A falling wedge is statistically a bullish reversal pattern, but, and this is critical, it's not confirmed until we break out. Until then, it is just a downtrend. Look at the moving averages. We are currently pinned below the 21 exponential moving average, the blue line, and the 200 simple moving average, the green line. As long as price is below these lines, the bears are technically in control. We have to respect that. We are guilty until proven innocent. Let's look at the math. I'm anchoring my Fibonacci retracement from the swing high of $4.20 down to the swing low of 55 cents. The price is currently struggling at the 236 level, which is exactly $1.40. This is our immediate ceiling. If we can break this level and reclaim $1.40, the next major structural resistance is up at $1.95. That's the 382 fib level and the falling wedge critical resistance. Now, look at the momentum indicator below. This is the Heikin-Ashi RSI. It's different from your standard RSI because it filters out the noise. We recently bounced from extreme oversold conditions. We hit the neutral zone, rejected, and are now pointing down again. This tells me we might have a few more weeks of chop or consolidation before the real move starts. The momentum is resetting, which actually gives us a better entry opportunity. So, how do we trade this without gambling? I'm treating the zone between $1 and $1.50 as my primary accumulation zone. I'm dollar cost averaging into my spot position here. I'm not going all in at once. I'm buying the red days. I'm buying the boredom. But every professional trader knows their invalidation level. For me, that line in the sand is 90 cents. If render closes a weekly candle below 90 cents, this falling wedge pattern probably has failed. The structure is broken. At that point, the probability of a flush back down to the cycle lows of 55 cents becomes very high. If that happens, I'm cutting my short-term trading position. I'll take the loss. I'm not going to hold a bleeding bag hoping for a miracle. Capital preservation is the #1 rule. Now, let's talk about the upside. If we hold support and break this wedge, I have very specific take-profit targets. I don't guess, I use the levels. Target 1 is $2, psychological and wedge resistance. Target 2 is $2.80. This is the 618 Fibonacci level, the golden pocket. This is where I'll trim my position the heaviest. Target 3 is the previous high at $4.20, and so on. My strategy is to scale out. If we hit $2, I sell a portion and move my stop loss to my entry price. This makes the trade risk-free. If we hit $2.80, I move my stop loss up to $2. We lock in profit as the market moves. We don't let a winning trade turn into a loser. I also have a contingency plan. We live in a world where Bitcoin dictates the direction. If Bitcoin loses the $60,000 support level, the entire altcoin market will collapse, regardless of how good Render's chart looks. In that specific scenario, if I see the 2-hour timeframe momentum indicators roll over, I'll open a hedge short. I will use low leverage, maybe 1 or 2x, targeting that 55-cent level. This isn't to make money, it's to offset the drop in value of my long-term holdings. That is how you yield pros manage risk. So here's the synthesis. The on-chain data shows us that whales are aggressively buying the dip while retail is panic selling. The fundamental landscape is strengthening with Robinhood and Grayscale's continued support. The technicals show a massive compression pattern that is forcing a move very soon. But remember, the trend is your friend until it bends. I'm positioning for the breakout, but I'm respecting the 90-cent invalidation level religiously. I'll be posting my exact entries and exits for this trade in real time. If you want to see exactly when I pull the trigger, or if I'm forced to open that hedge short, join my free Telegram group. The link is in the pinned comment below. And if you are looking for another infrastructure play that is showing this exact same bullish setup, you need to watch my breakdown on Chainlink next. The data there is even crazier. None of this is financial advice. I'm just a guy analyzing the data. Thanks for watching, stay safe, protect your capital, and I will see you soon in the next one.